Welcome to our latest Insider interview. Today in the studio, I have with me Simon Gergel, who is Fund Manager of the Merchant Investment Trust. Simon, thanks for coming in today.
Hi Carl, nice to meet you.
So to kick off, the Investment Trust aims to provide an above average level of income, and you're also looking for long-term growth. How do you define aiming to provide an above average level of income? Do you target a particular dividend yield, and do you target a particular level of dividend growth?
We don't target a specific level of yield or dividend growth because clearly the market yields go up and down, but the yield on Merchants Trust has been significantly higher than the overall market for many years. What we do target though is to grow that dividend every year, and we've grown it every year for quite a long time.
You typically focus more on the FTSE 100 index when looking for high-yielding companies. However, as we'll come on to a bit later on, you have been spotting more opportunities within the medium-sized and smaller-sized UK companies. Could you run through the current split in terms of company size in the portfolio?
Yes, so Merchants Trust's stated objective is to be predominantly invested in large companies in the UK, but we have moved quite a long way into mid-caps where we found a lot of value. So at the moment we've got about 55 to 60% in the largest companies, including a very small amount internationally, and we've got about 35% in mid-caps and maybe 4 or 5 in small caps and a little bit of cash.
And how many companies do you have overall? What's the typical range?
It's about 53 at the moment, and the range is normally 40 to 60, and we've been in that range for a long, many years. And
Merchant, it has an above average dividend yield. Is it typically a certain percentage over the index?
It's around about 25%, but it does move. So it's been, the yield at the moment is around about 4.5 to 5%, but it moves day to day.
And when you're examining the entire UK market, how do you ensure that when you're investing in a company that's paying a high dividend yield, that its dividend is going to be sustainable over time?
Yeah, well, it might surprise you, but actually the way we do it is to try to find companies where we think we can make money. So we do want them to have a yield when we buy them, but we take the approach that if you just focus on companies where the yield is sustainable and almost guaranteed or very secure, you may miss a lot of other opportunities. There are cyclical businesses that from time to time might cut their dividends in the cycle that might be very cheap and might be good investments. And there can be other companies that for all sorts of reasons might potentially cut their dividend. And that doesn't prevent us investing. We look for companies where we can make money. And ultimately, if you make money on a share, you can reinvest in another company paying income in the future. So that is our priority. It's always about total return. It's not about the income on any individual company.
So while it would be on a case-by-case basis, if a company you owned cut its dividend, that would not be an automatic sell?
No, not necessarily. I mean, we bought, for example, Burberry, which very soon after we bought it, we knew the company had trouble. The share price had come down a long way before we bought it. They actually changed the chief executive and cut the dividend, and we bought more shares because we saw the potential in the business and we saw what the new chief executive was doing. So absolutely not. It's about trying to make money on each share, and overall the portfolio has a good yield.
And does every single holding in the portfolio need to pay a dividend?
When we invest, we look for companies which have a yield close to the market or above, either today or within a sort of foreseeable future. But if a company cuts the dividend, we won't automatically sell it. We'll take a different view. We're much more pragmatic. If we own a company, and we might, like with Burberry, we might buy more.
And within the medium-sized and smaller-sized companies, where you've been finding more opportunities than usual, does this stem from the fact that the average dividend yield you can get in that part of the market, it's now actually, early this year, it became higher than the large company part of the market for the first time in I think about 20 years?
That's right. Hasn't happened in a generation almost that the yield on the mid-cap index is higher than the large companies. It's very unusual because mid-cap companies tend to have higher growth and tend to be a bit more dynamic, and they tend to therefore be more expensively rated or higher priced with a low yield. That has reversed, and that's not why we're buying mid-caps, but we're finding many opportunities because of that. Because that mid-cap area has been so out of favour on investors, we're finding lots of opportunities to buy really good companies at what we think are excellent prices. So yes, we're I don't like this phrase, we're leaning into that part of the market where we're finding mid-cap companies with good yields and attractive fundamentals.
Could you highlight a couple of examples of companies in that area that you've either added to or introduced as new holdings?
Yeah, so we bought a company called RS Group, which is an international distributor of components, all sorts of products that people need for keeping factories running and keeping industrial automation, keeping industries going, and also for design engineers. A lot of people know the RS catalogue as old. That's an interesting business that has been significantly derated. Another one you probably know quite well is a company like Money Supermarket, which owns Money Saving Expert, and that is a comparison website. That company, again, has been out of favour because there's been some challenges in an industry. That's brought the shares down to what we think is a very compelling valuation. So there's just been a number of different opportunities in that area.
And when investing in this area of the market, how much are you thinking about how economically sensitive a business is? As of course, companies outside the FTSE 100 index, they are typically more domestically focused.
Yes, they are typically more domestic and typically more cyclical, not in every case, of course. When we think about that, we think about the overall portfolio and say, how much exposure have we got in aggregate to areas like the domestic economy, like the UK versus international? And it's true that we have, as we've been buying mid-caps, we've been going more into those areas. But many of those areas we think are really interesting. Take the housing market in the UK, very depressed, activity is low, but the government is determined to increase house building in the UK. And all the companies associated with that would benefit from a recovery in due course when that happens. And valuations are very low. So we are taking advantage of those opportunities. And yeah, we've got a bit more in that area than we had previously.
You've mentioned house builders. Could you run through the exposure you have to that sector?
Well, the direct house builders, we own Bellway and we own Barratt Redrow. We used to own Redrow, got taken over by Barratt's, but we own building materials distribution companies like Grafton and Marshalls, which makes roof tiles and paving stones. We own Norcross, which makes taps and shower fittings. So we own a whole raft of companies in that area to get a broad range of exposures, and also some of the aggregate companies that make the dig up aggregates and make cement and so on.
And could you highlight other areas of the UK market where you're finding high yielding opportunities?
Well, it's quite a wide range. So the very highest yields, we've got companies like Legal & General, which is a life insurance company, pays something like an 8% dividend yield and a good record of growing that dividend over time. We've got at the other end, we've got a very small company called Duke Capital, which provides finance to small businesses that actually pays a 10% yield. And then in the middle, we've got a company like Energean, which is a mainly gas, but a bit of oil company in the Mediterranean that has got very long-term contracts to sell its product at favourable prices, and so it's got a very secure earning stream, and that also has a very high dividend yield.
Simon, thank you for your time today.
Thank you.
And that's it for our latest Insider interview. For more videos in the series, do hit that subscribe button, and hopefully I'll see you again next time.